Apple just reported record-breaking revenue. But the real story goes beyond the numbers. With strong iPhone sales and growing services, the company looks unstoppable. Or is it? Let's break it down. We are discussing on the FinTalk channel.
How does a single company generate $111 billion in just 3 months, but, manage to keep almost nothing sitting in its warehouses? That is the exact paradox we are looking at today. Welcome to this deep dive. Our mission for you, the listener, is to decode this one incredibly dense financial document. We are looking at Apple's official Q2 2026 earnings release, which covers the quarter ending March 28, 2026.
Yeah, and it's a raw 8K filed with the SEC, which means it is essentially this giant wall of accounting jargon, legal disclaimers, and just endless tables.
Right, exactly.
But that is exactly why it is so valuable for us to look at. Documents like this are designed for institutional investors, not casual reading, so they strip away all the marketing spin. If you actually want to understand how a modern corporate machine operates, well, the raw data in these filings provides the clearest blueprint available.
Okay, let's unpack this, because the top line number alone is just staggering. Apple reported $111.2 billion in revenue, which is up 17% year over year.
Yeah, that's huge.
I mean, to put that in perspective, they're generating over $1 billion a day. But I don't want us to just stare at the sheer scale of that number.
Right, because staring at the headline number doesn't actually tell us anything about the mechanics. Our goal today is to look under the hood of that $111.2 billion. We really need to identify the specific operational gears driving that growth.
Especially for an entity that is already so massive.
Exactly. A 17% leap at that scale seems, mathematically improbable.
So to find those gears, we naturally have to start with the physical products, because buying an Apple device is the entry point for, every single dollar the company makes. Looking at their condensed consolidated statements of operations, total product sales hit $80.2 billion for the quarter.
And you really have to consider the context of that number. In the exact same quarter last year, that figure was $68.7 billion.
Wow.
Yeah, adding over $11 billion in physical product sales in a mature tech market is incredibly difficult from a purely logistical standpoint.
And when you break down those categories, the iPhone is still driving the bulk of it. The iPhone generated almost $57 billion alone.
Just on its own.
Right. Last year, it was at $46.8 billion. That is a $10 billion jump year over year in a single quarter for a product category that many analysts claim has peaked.
Yeah, they've been saying that for years.
Exactly. And CEO Tim Cook specifically called this out in the text. He pointed to what he called extraordinary demand for the new iPhone 17 lineup.
He did, and he paired that observation with the introduction of what he termed remarkable new products, which suggests that the hardware portfolio is pulling way more weight than it has in previous cycles.
Well, I tend to view this new hardware lineup, the iPhone 17, the new M4-powered iPad Air, and this new MacBook Neo that Cook mentioned, as captivating customers. I view it as essentially a physical toll booth.
A toll booth. How so?
You are buying a VIP pass to enter their ecosystem. You pay the hardware premium just for the privilege of getting past the velvet rope.
What's fascinating here is how their chief financial officer, Kevon Parek, describes the outcome of people buying those devices. He doesn't just focus on the quarterly sales spike.
Right. He looks at the bigger picture.
Exactly. Parek specifically notes that this demand drove their installed base of active devices to a new all-time high. And that is across all major product categories and geographic segments.
Let's pause on that term, installed base, because you see it constantly in these reports, but it feels like, corporate shorthand.
It is corporate shorthand, but it represents the most critical metric for their long-term survival. The installed base is the total number of devices currently in use by customers out in the real world.
Okay, so it's not just what they sold this quarter.
Exactly. When Parek emphasizes that this number hit an all-time high, he is signaling to investors that Apple isn't just surviving on one-off hardware transactions. Every time someone buys that iPhone 17, they become a permanent resident in Apple's digital neighborhood.
So the installed base is the denominator for everything else the company attempts to do.
Yes, precisely.
That makes perfect sense. The hardware is the real estate.
Yeah.
And once you own the real estate, you can start charging rent. Which brings us to what happens after someone buys that VIP pass and gets inside the ecosystem. The services segment.
Yeah, this is where the underlying financial architecture of the company completely changes.
Let's look at the numbers because they are wild. Services revenue hit a new all-time high of nearly $31 billion this quarter. The previous year, It was $26.6 billion.
Right, massive growth.
But the revenue isn't even the most interesting part. It's the margins. If we look at the cost of sales in the operation statement, the contrast is really stark.
It really is.
I mean, to generate that $80 billion in the hardware sales we just talked about, it cost them over $49 billion. They had to buy aluminum, secure silicon chips, pay assembly workers, and ship physical boxes across oceans.
Because physical manufacturing carries heavy, unavoidable costs. The margins are fundamentally capped by the laws of physics and logistics.
But then you look at the services line. To generate that $31 billion in services revenue, their cost of sales was only $7.2 billion.
That is the magic of digital economics. Once the underlying infrastructure for a service is built, say, the servers hosting Apple Music or the payment rails for Apple Pay, the cost of adding one additional subscriber is essentially zero.
Just zero marginal cost.
Right. That $7.2 billion covers server maintenance, licensing fees, and customer support, but the vast majority of that $31 billion flows straight through as pure profit.
So what does this all mean? Looking at these numbers, I kind of want to challenge the way we classify this company.
Okay, I'm listening.
If it costs them a fraction of the price to make billions on digital services compared to their physical products, shouldn't we stop thinking of Apple as a hardware company?
That's a fair question.
I mean, from a purely mathematical standpoint, they look like a massive software and services firm that just happens to sell premium phones to acquire users.
That is a very common perspective among financial analysts, but it misses a critical nuance about how these segments interact.
How so?
Well, if you look at the company description tucked into the end of this press release, Apple explicitly tells us how they view their own architecture. They highlight 6 distinct software platforms.
That's iOS, iPadOS, macOS, watchOS, visionOS, and tvOS, right?
Exactly. And the text notes that these platforms provide seamless experiences to empower breakthrough services. They aren't separating the software from the device.
Oh, so they see them as one unified thing.
Precisely. They view it as a completely symbiotic loop. You cannot generate that $31 billion in high-margin service revenue without the proprietary hardware in the customer's hand.
So the hardware is the delivery mechanism.
Yes, it locks the user in, and the software is what makes the hardware so sticky that the user never leaves. If they stopped obsessing over the hardware, if they became just a software company, the foundation for those services would collapse.
Okay, so the hardware is the moat, and the services are the castle. That brings us to a massive structural question. We know what they are selling, we know the loop works, but where are they finding the room to grow 17%?
It is a huge question.
Right. When a company is turning over $111 billion in a single quarter, you assume they have to hit a ceiling at some point. There are only so many people on Earth who can afford a premium smartphone.
You would naturally expect to see regional plateaus. As one market matures, growth should theoretically flatten out.
Yet Tim Cook specifically highlighted, and I quote, double-digit growth across every geographic segment. The net sales table breaks this down. The Americas generated $45 billion. Europe came in at $28 billion.
And look at Greater China.
Yeah, it jumped from $16 billion last year to $20.4 billion this quarter. Japan hit $8.4 billion, and the rest of Asia-Pacific grew to over $9.1 billion. It's like a student getting an A+ in every single subject.
The fact that growth is occurring at that scale simultaneously across wildly different geopolitical and economic landscapes is highly unusual.
I actually want to push back on whether that's a good thing, though.
Really?
Well, if a company becomes this massive in every single market, doesn't that actually increase their overall exposure? Like, if there is a sudden global economic downturn, they take a hit everywhere at once.
If we connect this to the bigger picture, the reality of global economics is that recessions and booms rarely happen in perfect synchronization.
Meaning they don't all crash at the exact same time?
Correct. Different regions operate on asynchronous economic cycles. Look at the forward-looking statements section of this 8K. Companies are legally required to list their risks here, and Apple explicitly mentions the effects of global and regional economic conditions.
Right. They had to disclose that.
Yeah, because when a company relies too heavily on one specific geographic market, a local policy change or a regional recession can destroy their entire quarter.
But because they are pulling double-digit growth everywhere.
They create a geographic shock absorber.
Oh, I see.
Right, so if the European Central Bank raises interest rates and consumer spending cools in Europe, the Asia-Pacific region might be in an expansionary phase, which offsets those losses.
That makes a lot of sense.
By achieving deep market penetration across the Americas, Europe, China, Japan, and the rest of Asia Pacific, Apple proves their product appeal transcends local economic variations. It completely decouples their corporate success from the fate of any single nation's economy.
Okay, so if they are pulling in double-digit growth in every corner of the globe, the math dictates a massive buildup of capital. We are talking about billions of dollars physically accumulating. Where does all that money actually go?
The balance sheets and cash flow statements answer that call in directly, and I have to say, the strategy is aggressive.
Let's look at the condensed consolidated balance sheets. The company generated over $28 billion in operating cash flow in just these 3 months.
Let's define that for a moment because operating cash flow is very different from revenue or paper profits.
Good point.
Operating cash flow is the actual physical cash generated by their regular business operations after paying for the day-to-day costs of running the company. It is the purest measure of a company's ability to generate liquid wealth.
And they have a lot of it. I mean, they are currently sitting on $45.5 billion in cash and cash equivalents. Total assets are over $371 billion. We also see that diluted earnings per share hit $2.01, which is a 22% increase.
Diluted earnings per share is another critical metric to clarify. It calculates the company's profit divided by the outstanding shares of its common stock.
Right.
But diluted means it assumes all convertible securities, like employee stock options, are exercised. It is the most conservative way to measure profitability per share, and a 22% increase indicates they are becoming radically more profitable on a per-share basis.
Which explains what the board of directors did next. The release notes they authorized a massive $100 billion stock repurchase program and increased the cash dividend by 4% to total 27 cents per share.
Yep, a massive capital return.
But why? I mean, if you have $100 billion, why not build new factories or launch a dozen new product categories? Why buy back your own stock?
It really comes down to capital efficiency. At Apple's scale, simply throwing $100 billion into new factories won't necessarily yield a high enough return on investment. They already dominate their core markets.
So what does the buyback achieve?
By buying back their own stock, they reduce the total number of shares available on the open market.
Oh, so they are shrinking the pie.
Exactly. They are reducing the number of slices in the pie. If the company's total value stays the same, but there are fewer shares in existence, every remaining share automatically becomes more valuable.
That's clever.
It is a highly efficient, mathematically guaranteed mechanism for returning wealth to their existing investors without forcing those investors to pay taxes on a massive cash dividend.
Okay, that makes the mechanics of the buyback much clearer. But here's where it gets really interesting. Amidst all of this capital return, I was scrolling through the operating expenses on the income statement, and one specific line item really stood out. Research and development.
Yes. The R&D spend is always a tell for a company's internal anxieties.
Totally. Apple spent $11.4 billion on R&D in just this 3-month period. To put that in perspective, in the exact same quarter last year, they spent $8.5 billion.
It's a huge jump.
They increased their R&D spend by almost $3 billion in a single year. That is over $120 million a day spent purely on research. And I have to ask, why the sudden urgency?
It's a great question.
Like, if you're already making the iPhone 17 and you are raking in $111 billion, why pour an extra $3 billion into R&D right now?
It seems completely counterintuitive to accelerate spending when you are already dominating your rivals. But the answer is explicitly stated in the legal boilerplate we touched on earlier, the forward-looking statements.
You mean the section about risks?
Yes. People skip over it because it reads like legalese, but it reveals exactly what keeps Apple executives awake at night. The text outlines risks relating to the design, manufacture, introduction, and transition of products and services in highly competitive and rapidly changing markets.
Rapidly changing markets being the key phrase there.
Exactly. In the technology sector, resting on your current product lineup is essentially a death sentence. The ground is always shifting.
Right.
Apple isn't spending $11.4 billion a quarter to win today. They have already won today. They have already won today. They are spending that money to ensure they aren't obsolete in 5 years.
That makes a lot of sense.
Whether they are quietly developing new artificial intelligence models, iterating on the Apple Vision Pro, or engineering silicon that we haven't even heard of yet, that massive R&D budget is essentially an insurance policy against future irrelevance.
It guarantees that when the market inevitably transitions to a new computing paradigm, they are the ones leading the shift, rather than scrambling to catch up to a competitor.
Precisely. They use today's hardware profits to fund tomorrow's survival.
So bringing this all together for you listening, we've taken this incredibly dense 8K filing and tracked the actual mechanics of an Apple quarter.
We really broke it down.
We saw how the physical devices, the VIP pass of the iPhone 17, create a massive locked-in installed base. That base then fuels a high-margin services loop, where the cost of generating revenue drops dramatically.
Right, the digital economics.
And we explored how this loop is expanding globally, acting as a geopolitical shock absorber that completely decouples Apple from any single regional recession.
And we tracked how that operational efficiency generates so much liquid cash that they can easily authorize a $100 billion stock buyback to reward shareholders while simultaneously pouring $11.4 billion into R&D to engineer their next iteration.
It really is a masterclass in corporate mechanics. You really start to see how the gears turn beneath the surface of the press release.
It is. But before we wrap up, this raises an important question. I have one final mechanism I want you to think about, based on a single line buried deep in the balance sheet.
Oh, I saw you circling something in the assets column earlier. What did you find?
Look at the line for inventories. Apple's total inventories currently sit at just $6.7 billion.
Wait, $6.7 billion in inventory against $111 billion in quarterly sales.
Exactly. Just think about the physical mechanics required to achieve that ratio. How does a company operating on a global scale manage to manufacture and sell $111 billion worth of physical goods, but only have $6.7 billion worth of products sitting in warehouses at the end of the quarter?
That implies they are selling the devices almost the exact second they come off the assembly line.
It is a concept called just-in-time manufacturing, taken to its absolute extreme. Apple doesn't want to tie up its capital in warehouses full of unsold iPhones because inventory depreciates.
Right. Nobody wants an old phone.
Instead, they use massive leverage to force their suppliers to hold the components until the very last minute. They utilize incredibly precise, predictive analytics to forecast demand, and they lock up global air freight capacity years in advance to move the finished products directly from the factory floor to the consumer's hands.
So that $6.7 billion number isn't just an accounting quirk. It's proof that their supply chain operations are just as ruthless and innovative as the technology inside the phones.
Exactly. You see the shiny device in the store, but the real marvel is the invisible logistical network that allowed it to arrive there with zero wasted holding time.
That fundamentally changes how you look at a retail box. Thank you for joining us on this deep dive. The next time you see a headline flashing a massive revenue number, remember that the true story is never in the headline. It is always hidden in the margins, the cash flows, and the inventory tables. Keep questioning the mechanics behind the news, and we'll see you next time.